Morning and welcome to Fast Market. It's Monday, December 31st. I'm Tom White and I'm joined on set today by Scott Bauer, CEO of Prosper Trading Academy, and also Steve Rashis, Chief Options Strategist at M1 Capital Partners. Welcome, guys. Happy New Year. We've been off the air for about a week, so what a perfect day to get back into the markets here as we wrap up 2018. And I think we're going to get into that discussion a little bit. But Scott, we're falling from highs that we saw overnight and actually this morning. Yep. We're starting to see a little pullback in the overall equity market. Your take on the price action that we're seeing as we wrap up this year?
You know, Steve and I were just talking about this on the panel, and I think we're almost at the point here, the tweets don't matter anymore, right? It's almost like the little boy that cried wolf, yeah. And we have to really start sinking our teeth into some of the rhetoric that's coming out. We've got to see some action. We've got to see some activity. So that initial euphoria, you know, I'm looking up at the board here. We've sold off a little bit. Steve, I know you feel that, you know, sell every rally. That certainly has been the case here. Mm-hmm. And you know, it's almost what's that old saying of, you know, fool me once, it's my fault, or it's your fault, fool me twice, it's my fault.
Right.
That's kind of the sense out there I'm getting.
Yeah, to Scott's point here, Steve, is the fact that we did have some positive news coming out of President Trump and the administration saying that he had a positive call with the Chinese president on the negotiations that they're going through through trade tariffs. But to Scott's point here is the fact that are we just getting immune to it? And it's just like, oh, it pops up on our radar for about 10 minutes and then we push it aside.
Yeah, I think that, you know, I don't want to come across as like being too critical, but we've gone through a progression over a year and a half, and we've seen a certain methodology. You know, that the underlying story is that these trade deals are not in the United States' best interest the way they're structured. We're going to revamp these and we're going to make them better. Right. So we had some degree of success with that with NAFTA, with Mexico and Canada, and the arrangement, what they're trying to accomplish with China, in my opinion, is unclear. Because, you know, obviously all the tweets are, oh, we're about to make an amazing deal, is essentially the message. Yeah. That's not surprising.
But he wants it to be a level playing field. That's fine. I think that's what the administration wants.
Of course, and everybody wants that. But what makes people nervous is China is not going to just simply say, because they have a different perspective. Okay, we listen to a narrative about all the things that are wrong with the trade arrangement. Okay, that's not how they see it. So if you really want to sit down and negotiate and say, these are the issues, okay, do it off camera. Sit down with them, present your case, and hammer out a deal until something positive happens. Okay, this is too chaotic for the markets to deal with because nobody has a true sense of what they're trying to accomplish. Yeah. Okay, I mean, obviously I'd like to see, you know, my perspective is China is no longer an emerging market. It should not be treated as an emerging market. These are the things that we would like to see open up access to markets. These are the issues that we want to be treated more fairly, et cetera. Sit down with them and hammer it out.
Yeah. It's not going to happen behind closed doors.
But it's not going to happen in public like this either. Okay, well, this causes more stress.
I think it creates leverage for the people that are doing it. And now you got to remember this. This isn't just a U.S. against China, Scott. And just to what Steve was talking about is the fact that, hey, you know what? Other European nations, other countries are on board with us as far as stealing of intellectual property, not allowing investment like other countries do. So China has these barriers that need to be broken down, according to some.
They absolutely do. But, you know, much to Steve's point, and I'm in the same camp here, we've had this same rhetoric for 18 months. 16 months, whatever it is. Market's getting tired of it. That's not just an opinion of mine. That is not a political opinion. It's not a personal opinion. The market is getting tired of it. And until there's actually some action behind it, you're going to see the elevated VIX. The market does not like this sort of uncertainty, and we're going to see this fade the rally, buy the, just buy a dip without any sort of fundamental type of trade until there's actually something with substance.
Yeah, and that's the thing. The fundamentals are still relatively pretty good, guys, as far as economic data goes. We did have one economic data point this morning, Dallas Fed manufacturing, which actually came in negative. And this is the third regional manufacturing number, along with the Empire State and the Philly Fed, that were weaker than expected. And that might be, a precursor to what's going on in the overall market. But Scott says that the markets don't like this, right? And volatility is elevated. Well, as an options trader and the moves that we've seen, I like it. I like higher volatility because it provides more opportunities. Now, if you're a long-term investor, you got to ride through these waves because we've had a 10-year rally almost straight up. So shouldn't this be happening in the market?
Absolutely. Yeah, I don't see this. So I think I look at it in two ways. So from a trading perspective, obviously, this creates more opportunity when there's two-way movement. Okay, so that's for sure. But it's really unusual, too. You have a better trading environment and you have a better investing environment. Because from my perspective as an asset manager, I care mostly about valuations. I don't want to be in the business of predicting what's going to happen next year, but I'd rather buy the S&P, for example, at 14.5 times earnings than at 23 times earnings, regardless.
Yeah.
So this is a weird environment where, for the first time in a long time, you've had a better trading environment and a better investing environment.
Yeah, and think about it, Scott, to what Steve was talking about, is that this might give you opportunities to get into names that maybe have pulled back 15, 20, 30% over the last several months. And is that a bad thing?
No, I don't think it's a bad thing at all. And, again, you have to separate trader, investor, this, that, and the other, and have that mindset on. That being said, and I know we're going to talk about it shortly, some of the banks, to me, are really, really enticing because not where interest rates are going, but because trading revenue should be absolutely better than we have seen in last 5 years.
Yeah, I know.
Because of the volatility.
And you saw, typically we see volumes start to tighten up a little bit through the month of December, Scott. And
not this year.
Not this year. And I've been following a lot of the OCC, the Options Clearing Corp, and some of the options data that's trading on a daily basis. And that also includes equity trades also. It's really robust. And, with Scott's point here that, hey, you know what, this is going to be good for banks, but they trade at really low valuations. They're underperforming the overall market. Your thoughts on this, Steve, as financials have taken it on the chin, even though the 10-year yield, which they're highly correlated to the financial industry, it's still up from the start of the year, but it's pulled back over 50 basis points over the last several months.
Yeah, well, I think all of that really just creates a story where valuations have compressed. So you've got an opportunity, again, as a trader or an investor, to be in a more favorable environment. I mean, at the end of the day, my preference is always to look and say, all right, if I look at the best of breed banks that I really want to invest in, whether that be a JP Morgan or what have you, I like this action way better than when the stock is pushing 115 and I'm forced to buy it at a price level I really don't want.
Right.
So that's how I tend to look at it. How this plays out I don't really care so much trying to figure that out. But the bank stocks are certainly cheap in relation to to where they've been and the broad market. Yeah. So to me, it's a good opportunity.
Let's see if they're cheap for a reason.
Well,
that's the concern.
They're cheap. They were just expensive, and now they got cheap really quickly.
Right.
So that just is a reflection of the fact that I really don't think anybody has a clear idea on what they want to do yet.
They're going to follow the economy.
There's no conviction, right? And there is a positive scenario really setting up, is that if the economic activity stays where it is or continues to grow, and you remove some of these political stresses, and you get a genuine resolution, when collectively the administration here and China and all the other partners realize, look, this is in no one's best interest to do all these things. Tariffs are not good for anybody. So let's sit down and hammer it out and figure out what we're going to do. So that's the potential really strong upside scenario.
Now, what pulled us back, kind of pivoting, what pulled us back this morning, I think the biggest thing was the fact that oil turned around. Oil was up a couple percent to start the day. It's down over 3% from its highs that we saw earlier in the session. And stocks have been following oil prices, relatively, highly correlated over the last week or so, Scott. So your take on the oil market, what happened, why it's pulling back, and why it's helping drag equities a little bit lower?
Well, I know some news came out of the Iranian exports to Asia, 5-year low there. And I think, again, though, it's just the overall market sentiment. Steve, how many times you said this, selling every rally. It's not just in the equities. It seems to be in the oil space, whereas just a few months ago, it was buying every dip. Now it's selling every rally. The bottom line with oil is, though, we don't know whether it's fundamentally because of an oversupply or if there really is just a demand issue. And I don't think there's going to be any resolution to that in the near future. Near future meaning 3 months, 6 months. And so for right now, the overall sentiment is sell every rally.
Yeah, and if you want to, Ryan, if you can follow us to the trading platform, we've got a 1-day, 1-minute chart in crude oil for you, just to kind of take a look at. We saw those highs above 46.5 earlier overnight, but it's continually slid down, now just below $45 a barrel, Steve. To Scott's theory that, hey, do we know if it's a demand issue? Because if economies are slowing down, whether it's China, whether it's Europe, there's going to be less demand. And that's a concern for this particular sector as it's been under pressure. Your thoughts on oil and the movement that we've seen?
I think Scott's 100% right. I actually believe it's both. And I think what you're seeing, there's supply is always relatively robust, meaning all the oil producers, there's a balance that they want to achieve, and they can always ratchet up their production. Okay, so now what you've seen is a slowdown in China, a slowdown in the global economy to a small degree. Oil's had, and you combine that with an unwind of a really big, years-long trade of long oil, short natural gas that unwound at the 70-plus-ish range when that started to implode. So you combine all those things together, and it's not a pretty picture in terms of having a real stabilizing rally going forward. So I think it's going to take time for producers to ratchet back the economy. The demand picture has to stabilize or get stronger. You're going to see these fading rallies, in the crude market until those things get resolved.
And if we can see catch a bid in crude, that might actually prop up equities.
Every product will get to a price point at some point where there are legitimate, strong buyers, and that's what you're probably going to see here.
Yeah, we'll have to see.
Hopefully it won't be too much
We'll
lower.
have to see if it can show that bottoming, that rounding pattern that we've seen about $44 a barrel, $45 a barrel, if it can hold here. But I kind of wanted to move to economic data this week. So really light today. We just had the Dallas Fed underperformed. It was actually a negative number, expected about 17, came in, I think, minus 5.1. Yeah, minus 5.1. So that was a severe miss. But what are you looking at, Scott? What are you focused on this week? Because there is a lot of data in the latter stages of this week.
Yeah, I mean, you have to look ahead to Friday, to the jobs number, right? I mean, where are we going to come in? How reflective is it going to be of seasonality with the Christmas season and hiring for the fourth quarter? So I think that's the big one. Thursday we have mortgage apps, but that's pretty much been almost a B or a C level is what Kevin Hinks would say to that. So I think you have to look ahead to Friday.
Yeah. Steve, your take on the economic data this week, and what are you looking at? What are you focused on? Because there's no earnings this week.
Yeah, no, I agree. I think the unemployment numbers are going to be the big one. And I'll be honest, I'm not so sure if any of these numbers have that strong an impact just yet. What you want to see is some sort of stabilization and no rolling over in any meaningful way. So when you start to see the data points that we came out today, those are a little concerning that that's not healthy. I think the unemployment numbers are going to be key. I think they're probably going to be relatively similar to what you've seen, strong, et cetera. But I don't put a lot of importance, to be honest with you, on any individual data points. As long as they're okay, the market doesn't care about that right now. There's bigger issues that are more important.
Yeah, you're correct with that. But if you take a look at the China data that came out, their manufacturing data actually pulled below 50, which is
they've had multiple data points that have been poor.
The line between expansion and contraction, I think it came in at 49.4%. So. Maybe that slowdown in the global economy is starting to take hold over there. We'll have to wait and see on that. But the numbers that I'm looking at, guys, and it goes in conjunction with this Dallas Fed number. Manufacturing, we have PMI on Wednesday, ISM manufacturing on Thursday. These numbers are expected to be a little bit lower. They're still in expansion territory above 50, But those are the numbers I'm going to be looking at closely for any signs that we're slowing, the economy slowing. Now, a lot of the numbers that we've seen recently in those data points has been inventory buildup ahead of the tariffs and concerns about that. If we see that pullback or maybe inventories are getting too big, those are the numbers I'm going to focus on. Do you take that as a measure of what can stocks do based on those numbers, Scott?
It's real hard to just pinpoint one particular number coming out. And Steve just said it. You know, all of these numbers coming out collectively may mean something, but one just in and of itself is a bit difficult in this environment that we're in right now to really pin your hopes on or to pin, you know, what the next move in the market might be. But that being said, we have seen some weakening. Mm-hmm. We have seen a little bit of weakening. That's natural, and that could be some of the cause for, you know, Goldman reducing their expectations as they did, and, you know, it does have to be considered.
Yeah, and also on tap on Friday that we haven't mentioned is the fact that Powell speaks in the morning on Friday with ex-Fed chairs Bernanke and Yellen for maybe we'll get some sound bites out of him. Kevin Hinks always loves those sound bites out of Powell because he can change the equity market, and he's proven that. Do we expect anything on that speech or that little panel that they're doing?
Well, I mean, that's a really hard question to answer. I mean, my preference, I'm very happy to see Chairman Powell, you know, stand his ground, do what they think is right. Not, you know, everybody that wants to see stabilizing in the markets, you know, they got to blame somebody, right? So why did he raise interest rates? Why is he doing this? Why, you know, they're doing what they believe to be right based on the strengthening economy over the last couple of years. They're trying to get rates a little bit higher, reduce their balance sheet. In my opinion, nobody should talk about any of the stuff they're doing. They should have one press conference after they make a decision, lay out their case, and that's it. You certainly don't want the political and the Fed spheres to mix, period. When they talk now, I think everybody realizes how sensitive the markets are to every whisper that they say. Okay, so to me, they just have to deliver a constant message. And if you listen to, you know, Janet Yellen came out not too long ago, you know, and Greenspan, who periodically...
Well, they're already coming out with...
They've already come out, and they have said some things that are really a little bit scary to investors. Like, okay, I mean, even Greenspan, I don't want to quote him because I don't remember exactly what he said, but something to the effect of run for cover. Okay?
Cash isn't a bad thing, right?
Exactly. So you had multiple Fed governors coming out, you know, telling this story that does not inspire confidence.
Well, the thing about this, when Yellen was in office, the economy was doing well, growing. They were telling her to hike rates, and she didn't at the beginning. And Bernanke didn't at the tail end of his. So they were already behind the curve, according to a lot of people. And those are the same people that are saying now that they shouldn't be hiking at all in 2019. And then you get reports that some people are saying that they might actually cut rates next year. So they've been behind the curve, and their forecasting has been suspect at best, but I'm going to leave it there because I don't want to judge on that. I want to kind of move over to discussion about financials, guys. Sure. This sector's been beat up pretty severely, Scott. Like we said before, valuations are extremely low in some of these big asset holding banks like the Citigroups and JP Morgans and Bank of Americas. But then on the investment side, you're seeing pressure on Morgan Stanley. You're seeing Goldman Sachs just get obliterated this year. And moving forward, what do you look at in this particular financial sector for our viewers out there? What kind of stocks are you looking at in this particular sector?
The big guys. We hit on this earlier. JP, Goldman Sachs, probably Citi. I want to look at the big trading banks. Okay. Because again, I think that's where we are going to see some major outperformance coming through in the next quarter on their earnings reports, because of the volatility that we have seen over the last 3-6 months in this marketplace. So compare where we were a year ago with rates relatively right here to the levels, like you said, Steve, you didn't want to be forced to buy JP Morgan at 115, 116 when rates were 270, 275 a year ago or whatever it was. Now, you know, is it on sale because it's 20% less right now with rates at the same point? So that's why I am very bullish on a couple of the big banks, the big trading revenue banks. I love JP Morgan. I want to buy some upside going out, whether it's by calendar spread, buy some puts and stock together. You know, so I have a little hedge to the downside, but still have that upside move because I actually own the stock as well. So those are two of my strategies that I would look for in JP Morgan.
You know what? Scott, I love the theory here, because if the economy is going to do well, the banks should participate in any movement upwards, right? That typically is what happens. And we're not going to get a rally until these things rebound. JP Morgan, to Scott's point, down 9% in 2018, but Goldman Sachs down 35%, Citigroup down 30%, Steve, and Bank of America off about 16%.
Yeah.
So there's opportunity there if you believe in this economy and that we're going to be, sustaining growth rate above 2.5% up to 3% into 2019. But a lot of things are going to be dependent on that. What do you look at when you look in this sector as far as trading opportunities if you're looking at maybe a strategy?
Well, I agree totally with Scott. In my opinion, JP Morgan is kind of best of breed. So, in terms of strategies, all the strategy sets we talk about here, short put vertical spreads, potentially long upside butterflies or calendar spreads, simple cover call positions, all of those strategies I think are in play here and are certainly reasonable to look at. I would offer one other thing. I think in terms of upside potential, Goldman clearly once, or if they get some of these legal issues resolved, I think they have the better upside potential because they've been hit the hardest coming into this.
And the uncertainty around them with up to maybe $5 billion in fines.
Absolutely. So I think at some point, that will stabilize and they'll figure out a way through that. So I think that the upside potential could be better there just simply because they've been hit the most. But again, I think using defined risk positions is the way to navigate this because, it's still uncertain how things are going to play out.
And they all have earnings coming up in the next 3 weeks.
They have earnings coming up in the next 3 weeks.
So that's definitely a good point.
The vol is going to be higher.
Yep.
So you can certainly take advantage of that to either sell, obviously, either sell some put spreads if you want to put on bullish positions.
Well, let's do that. Let's create a couple strategies in here. And Scott, I wanted to hit on that one that you mentioned first, and that's an upside call calendar in JP Morgan. It's a neutral to bullish type stance. We've got one built here in the platform if Ryan wants to follow me here. This is selling the January 11th 100 calls, which is about $3 above where the current share price is, and buying the February 100 calls for a debit of about $1.87. Now I want to analyze this, Scott, and you can walk us through the setup on this type of trade. You see the calendar spread there at the bottom, $1.87 debit, and here's the risk profile of that. It's above the current share price, which is right about here. At apex is about the 100 strike. Now, typically we like to initiate calendar spreads in low volatility environments, but at the same time, if you have a directional bias, sometimes you can push that aside. Is that true?
Absolutely. And what I would actually do with this one, Tom, to take away some of that volatility risk, I'd actually skew this.
Okay. I
want to still sell that January 11th because I want to take advantage of this really high premium going into earnings.
Right.
I want to buy a lower strike call though.
Okay.
So still turn it into a calendar because I want to buy myself time, but I'm going to give myself extra delta. I'm going to give myself extra curvature to the upside by buying a lower strike call.
Okay.
And I'd actually go a little bit further out as well, but we can construct it.
Let's go ahead. Go ahead and walk me through it.
So I definitely want to sell the Jan 11. You can keep the 100 strike call in there. And I'd probably go out either to the end of Feb or even out to like mid-March.
Okay.
And look for, I don't want to do the 95. I want to try and get a weekly where I can buy a 97.5 strike somewhere.
Yeah, we don't have any weekly options out there.
So that's a little limited there.
Yeah.
What's the Feb 8? Let's
go with Feb 8. That's a little shorter duration, yeah.
But that's okay. You know what? I'd rather do that and buy maybe the 97.5 or 98 strike call there.
Okay, and you're buying the at-the-money call in the further term option.
Yep.
So we can create that, and it's called a diagonal. It's in the calendar spread family. We're taking a $2.80 debit basically on that. Let's go ahead and analyze that so our viewers get an idea of what Scott's thinking about. And I'm going to delete the initial calendar. So this skews it towards the upside a little bit more, and Scott's correct here, where you're buying the 97.5 in the February 8th cycle, and then you're selling the January 11th calendar spread family, but the apex is still at 100.
Right, because that's our short strike. But now if we start to get that move above 100, whether it's due to coming up running into earnings or it's just a gradual move, this thing is going to be great. This upside is actually going to hold. It's going to extend. I think right now our break even is around 108 or so. I'm great with that.
Yeah, and your debit that you take on this diagonal spread is your risk in it. And
Right.
so it's still risk defined, upside skewed, which is nice way to play it if that's your assumption going into it. All right, I'm going to bring Steve and Scott back later on in the show. Maybe we'll get to one of those short put verticals in there, Steve, on the way back. But coming up next, it's Face Off. We're going to look at technicals versus fundamentals. We'll take a look at the S&P 500 index, the SPX. Stay right here on the TD Ameritrade Network. Fast Market will be right back.